Microsoft's Q3 fiscal 2026 earnings were not just a beat, they were a test of the AI investment story. Revenue came in ahead of expectations, diluted EPS beat consensus, and cloud demand remained the center of gravity. But the same quarter also sharpened the key investor question. Can Microsoft turn enormous AI infrastructure spending into durable earnings power fast enough to justify the capital being deployed? For retail investors, the read-through is straightforward. The business is still compounding through cloud and AI, but the bar for execution is rising. Start with the headline numbers. Microsoft reported Q3 fiscal 2026 revenue of $82.886 billion, compared with an estimate of $81.44 billion. That is a 1.8% revenue beat. Net income was $31.778 billion on a GAAP basis. For the bottom line earnings comparison, the cleaner metric here is diluted EPS. Microsoft reported diluted EPS of $4.27 versus an estimate of about $4.06. That is a 5.2% beat. In 1 cent, the quarter cleared the consensus bar on revenue and diluted EPS, while net income support in the package is best treated as reported GAAP profit rather than a verified consensus surprise. The revenue mix tells the real story. Total revenue grew 18% year over year. Product revenue was $15.089 billion, down 1.5% year over year. Service and other revenue was much larger at $67.797 billion, up 23.8%. That shift matters because it shows Microsoft leaning harder into recurring, cloud-oriented, and services-driven economics. By segment, productivity and business processes revenue was $35.013 billion, up 17%. Intelligent cloud revenue was $34.681 billion, up 30%. More personal computing was $13.182 billion, down 1%, and Microsoft Cloud revenue reached $54.5 billion, up 29%. The visual emphasis should be clear. This quarter was carried by cloud and services, not by the legacy product bucket. Profit quality was solid because the growth did not stop at the top line. Microsoft reported gross profit of $56.038 billion against total revenue of $82.886 billion. Operating expenses were $17.66 billion, up 9.4% year over year, while operating income was $38.398 billion, up 20%. That is the operating leverage investors want to see from a platform company. Revenue up 18%, operating income up 20%, and net income up 23%. The expense base is still expanding, especially as AI capacity comes online. But in this reported quarter, the income statement shows growth dropping through to profit rather than being fully absorbed by spending. Guidance is where the debate becomes more forward-looking. Management guided Q4 fiscal 2026 total revenue to a range of $86.7 to $87.8 billion. The selected next quarter revenue estimate in the package is $87.61 billion, which sits inside that range but above the midpoint. Segment guidance keeps the same pattern. Productivity and business processes is guided to $37.0 to $37.3 billion. Intelligent cloud is guided to $37.95 to $38.25 billion, with management expecting Azure growth of 39 to 40% in constant currency. More personal computing is guided to $11.75 to $12.25 billion, with pressure from Windows OEM devices and Xbox content comparisons. The strongest forward signal is still cloud growth. The biggest constraint is that Azure growth remains supply constrained. The stock setup was not euphoric going into this story. The one-year price history in the package shows Microsoft down 7.9%, moving from a starting close of $463.87 to an ending close of $427.34. The one-year high was $542.07 and the low was $356.77. Around the selected option expiration, the at-the-money straddle implied a move of about $9.68 or 2.26%, with an estimated range from $417.67 to $437.01. After the April 29 earnings release, MarketBeat showed extended hours trading at $420.77, up 0.4%. The market reaction was measured, not explosive. For valuation, use the PE times EPS framework as an educational lens, not as investment advice or a price target. The current market price in the package is $427.34. The channel's reasonable P range for Microsoft is 23.5 times to 31.5 times, with a 27.5 times midpoint. Using current fiscal year EPS of $16.81, the implied range is about $395 to $530, with a midpoint near $462. Using next fiscal year EPS of $19.34, the range moves to about $454 to $69, with a midpoint near $532. That puts the current price below the next fiscal year low case in this framework, but the conclusion depends heavily on whether those earnings estimates and Microsoft's AI return profile hold. Management framed the quarter around cloud and AI demand. Microsoft Cloud revenue reached $54.5 billion, Azure and other cloud services grew 40%, and management said AI annual revenue run rate surpassed $37 billion, up 123% year over year. That is the bull case in a single cluster of numbers. The risk is the cost of meeting that demand. AI capacity demand still exceeds supply. Q4 capital expenditures are expected to rise above $40 billion, and calendar 2026 capex is expected around $190 billion. For shareholders, this is the trade-off. Exceptional demand on one side, execution and return on invested capital risk on the other. The final takeaway. Cloud and AI strength outweighed heavy investment risks in Q3 fiscal 2026. Microsoft beat on revenue and diluted EPS, showed strong operating income growth, and guided to another large revenue quarter. But this is not a simple victory lap. The stock now depends on whether AI capacity spending converts into revenue, margins, and cash returns at scale. For long-term investors, Microsoft remains a quality compounder. But the next chapter is about proving the return on the AI build-out.